Ladies and gentlemen, good day and welcome to Brookfield India Real Estate Trust earnings conference call for Q1 FY23. As a reminder, all participant lines will be in the listen-only mode until the floor is open for questions. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. On the call, we have the following persons: Mr. Ankur Gupta, Managing Partner, Brookfield Asset Management and Director, Brookprop Management Services Private Limited; Mr. Alok Agarwal, Chief Executive Officer, Brookprop Management Services Private Limited; Mr. Sanjeev Kumar Sharma, Chief Financial Officer, Brookprop Management Services Private Limited, and Mr. Rachit Kotari from Brookfield. I now hand the conference over to Mr. Ankur Gupta. Thank you, and over to you, sir.
Thank you. Good afternoon, everybody. A very warm welcome to our first quarter analyst briefing call. And as always, we are thankful and grateful for your time and for your support to our business. Quarter one for this fiscal year is off to a fantastic start in our business. This quarter can be described as advancement of our business plan in terms of organic growth, a combination of strong releasing spreads, as well as occupancy gains, and characterized by a return to office for most of our tenants, which is resulting in space take-up by new tenants, of course, but also a majority of space take-up coming in from existing tenants. We continue to show stewardship in advancing our ESG plans for the portfolio that the management team will talk about in detail in this call. But overall, very pleased with the performance of our business as a start to this new fiscal year. And I'll request Alok Agarwal, the CEO of the manager of the Reit, to take you through the results of this quarter that we're reporting today.
Thank you, Ankur. A very good afternoon to everyone. I'm pleased to say that the robust recovery we saw in the second half of FY 2022 is only continuing and extending. We are seeing return to office trends playing out across the country. The steady uptake in physical attendance, as we have witnessed at our assets, coupled with robust hiring by tech companies over the last couple of years, both well for the demand for commercial real estate in India. We witnessed strong leasing demand across our assets this quarter with 311,000 square feet of gross leasing at a re-leasing spread of 27%. Additionally, we also signed about 94,000 square feet of expansion options during the quarter. Over the last 3 quarters, we have achieved a total new leasing of 1 million square feet, which is higher than our average new leasing run rate prior to COVID pandemic. While last year's leasing was predominantly driven by relocation and consolidation, we are now seeing expansion demand from our existing tenants, with 85% of the new leases this quarter being signed with existing tenants. This strong leasing demand has been accompanied by a healthy rental growth. While we had achieved a re-leasing spread of 11% for financial year 22, in the last 2 quarters, we have been able to achieve re-leasing spreads of 27% in each quarter. This is driven by greater leasing demand as more employees return to office and realization of mark-to-market headroom in our assets. Before the pandemic, we typically witnessed 2 to 2.5 million square feet of net leasing every 2 years in our assets. With 0.3 million square feet of expansion options signed and 1.1 million square feet of ongoing leasing discussions, we are hopeful of continuing our pre-COVID net leasing run rate. This should help us achieve our stabilized occupancy and our organic growth targets. We have already achieved a 6% growth in our NOI run rate in this quarter, and continue to have an embedded growth headroom of 15 to 20% till stabilization. So the strong leasing that we saw during the quarter, we have achieved an effective economic occupancy of 89%. Our existing leases also delivered robust embedded growth with 9% average escalation on 1.1 million square feet during the quarter. Rental collections remain strong at 99% for the quarter. We have also completed the 1.55 lakh square feet of Tower 11A in N2 in May 22, which is covered under the income support from the sponsor group. The REIT has an attractive pipeline of inorganic growth opportunities. Candor Tech Space G1 is fast approaching stabilization. Also, the rent-generating assets totaling 2.7 million square feet in the Powai Business District are part of the ROFO estate and are undergoing a carve-out. We believe that these high-quality assets could have a significantly positive impact in broad-basing our REIT if we were to acquire them. The combined portfolio would lead to a 15% decrease in the top 10 tenant concentration and would improve the weightage of Mumbai to one-third of the portfolio. We have taken significant steps towards our goal of achieving industry-leading sustainable development. We have replaced about 15% of the A2 fans and filters in G2 to enhance energy efficiency by 25% for these replacements. We also sponsored a zero waste run at Powai as part of our launch of the Break the Plastic initiative, attracting 2,000 plus participants to the event. We have completed the submission for the GRESB score in FY22 and are on track to fulfill the commitment to establish decarbonization goals based on Science-Based Targets Initiative (SEBI). Our efforts at Candor Tech Space N1 and K1 were recognized by the CII as we won the CII Inter-Industry Kaizen competition. We are on track to end FY23 with lower energy consumption, lower greenhouse gas emissions, water usage, and solid waste emission than FY22. This is despite the addition of N2 to the portfolio. We will continue our efforts to deliver long-term value to our business, partners, and communities. Now I would like to invite Sanjeev to provide the financial update.
Thank you, Alok. Good afternoon, everyone. I am pleased to announce that the board has approved a distribution of 171 crore rupees, means 5 rupees 10 paisa per unit this quarter. The tax-free component of distribution this quarter is 52%, which is in line with our stated target. We have achieved an NDCF of 172 crore rupees, means 5.13 paisa per unit, which is in line with the guidance provided last quarter. Factoring in the recent leasing success and strong cash flow generation from existing leases, we believe we will be able to comfortably maintain our NDCF guidance and our distribution run rate. Our operating lease rentals for the quarter are 203 crore rupees, which is 26% higher than the same period last year. The adjusted NOI, including income
Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rajiv Malhotra from Skanda Investments. Please go ahead.
Good afternoon, everybody. These were fabulous set of...
Mr.
Yes?
Malhotra, you're sounding very soft.
Is it better now?
Much better, thank you.
Yeah, thank you. Good afternoon, guys. I think the numbers were absolutely outstanding. So a great quarter for everyone. I have two questions. One is on Candor G2. Is there some sort of weakness we see in G2 because the releasing also seems to have happened at a 9% discount? Again, on G2, we are doing some developments in the food court and gym, while in the offer document, we were talking of some new tower which is to be built there. Can I have your color on that?
I can take this question, Rajiv. So, Rajiv, in G2, yes, we closed with a slightly lower number, but this was with the anchor tenant, and discussions have been going for quite some time. And discussions, kind of started 2 quarters back, and you are aware that tenants take a bit of a time to close the leases. So, and about 2 quarters back, a bit of a negotiation happened, and we did close at a lower number. But overall, we have, our sense is on an average, we should be able to kind of surpass the business plan when we do the further leasing. And that's what we always do. About 1/3 could be at lower number, balance 1/3 is at the business plan number, and 1/3 could be to upside. That's the normal trend we follow also, at many times. So that's answer to your first question. Second thing is, I'm not aware of a new tower in G2, but yes, we are enhancing the capacity of food court, and we are enhancing the capacity of gym, because they rest from our tenants, as when they take the space, they feel they would need more space in food court. And gym has been a big attraction actually. The existing gym is not sufficient to, house all the people who want to participate or go for the exercises. So it's more of an amenity we provide, and that we always do to attract and, kind of attract the tenants and remain them committed.
Okay. One thing on G2, from the original acquisition of this asset into the REIT, this is more of a agreement to use asset where the land is not in our name, in the trust's name, and also the original developer holds a lot of space. Is it not fruitful for the trust to get the land? Because this is India. Anything can happen, right? So isn't it great to have the land back into the trust name and try to buy out the balance share of the original developer?
So our contractual position in this asset has been maintained for many, many years and enjoy a fantastic relationship by our partner here. While the land ownership is not in the trust, the contract that governs our right to enter this land is perpetual and operate, and our share of the area / revenue is also perpetual in nature. So I would classify it as a fantastic agreement that we have with a very dependable partner. In future, if something were to change, both parties have to come to a table, and we don't see any requirement or motivation from that front at this point between the two parties.
As of now, there is nothing going on. That's it.
Yeah, but our rights as a partner here are rock solid.
Okay, great. So one last brief question on K1. K1, we are doing a mixed-use development. Are we to understand this is non-SEZ and outside this thing, and any reason for doing that? Also, in your term sheets, you had shown that the same G2 developer is going to be a partner in K1 for this mixed use. Any particular reason for making it like this?
So look, it's a very large asset, And the fact that this part of the land does not have the same restrictions as the other balance parcel allows us to add amenities and mixed-use portion, which has a very strong, our market research suggests, has a very strong demand. So we've embarked upon that plan and are in the pre-development mode there. As I said, our relationship with the JV partner is solid, and they express interest in coming into a small portion of this development, which also helps de-risk this development from an execution perspective. So I hope that answers your question. And just a simple request to the moderator, because we have limited time. If you can limit questions to one or two per person, and then if anybody needs to get back in the queue, they can do so.
Yeah. Thank you, guys. Thank you for your answers.
Thank you.
Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, we request you to limit your questions to two per participant only. If time permits, you can come back in the question queue for a follow-up question. The next question is on the line of Mandeep Singh from Ambit Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. So firstly, can you help us understand how the physical occupancies have ramped up across your portfolio assets? And if you could provide some sense on micro-market-wise breakup?
Yeah, so, the physical occupancies, of course, they kind of a bit vary from asset to asset and, micro-market to micro-market. Wherever we see large tech companies, their occupancies are, a bit lower actually, because they are providing more flexibility to their employees for next 2 to 3 quarters. Wherever there are smaller companies or mid-sized companies, they are insisting to the employees to please attend the office, at least 50% attendance they want, on a given day. So our occupancies would be in range of, I would say, 35 to 50%. And if you really say like in Bombay, in Bombay where we have Kensington, we have one large company, occupying substantial portion of that space, where the occupancy are lower, about 30 to 35%. In Gurgaon and Noida, and especially Noida, occupancies are high. They could go 45 to 50 because they're smaller companies and they're insisting that people have to attend offices. They have almost kind of a mandated 50% occupancy on a given day. Calcutta again, they're large tech companies, large IT companies. They are taking more time on the employees to come back to offices. So again, Calcutta, they are a bit lower. But as I said, so Bombay is lower for the last tenant being there. Calcutta is a bit lower, and Gurgaon and Noida occupancies are higher, almost hitting 50% in Gurgaon also, and Noida also.
And if I may just add, globally we are seeing a massive preparation to be almost entirely in terms of the companies getting back to work post summer, which is Q3 of the calendar year. And then most organizations have laid out plans for that, for most of the employees to be back in physical offices starting end of the summer.
So this is really helpful. And secondly, if you could just help us with micro-market-wise broad split for your 1.1 million square foot of ongoing leasing discussion, that would be helpful.
Yeah, so, if you really point 0.45 million square feet. Then if you really see in G2, we already have about 0.35 million of hard options. So, that is in addition to this 1.1 million. So, they would kind of, they also actually, they're part of leasing discussions because they would come and people would, at least 50, 70, 60, 70% would renew. So it's spread across assets, but of course it's stronger in Noida right now, and Calcutta is lower end of spectrum.
That is really helpful. I'll just come back in the queue for the follow-up. Thank you.
Thank you. We'll move on to the next question. That is from the line of Puneet from HSBC. Please go ahead.
Yeah, thank you so much. Good afternoon and congratulations on good distribution. My first question is if you can give more color on what are you seeing in terms of market rentals. At least in Mumbai we saw a good 113% leasing spread. Can you indicate what were the indicated rentals there?
Yeah, so Mumbai is, kind of we are costing 125 rupees kind of a rental. That's at least we are getting 125, 130 kind of a rental. And it's a small lease, we probably will push it higher. But for a large or medium-sized lease, it could be around 125. And that's something, I think that's becoming kind of a floor, I would say. Around that, 125 is becoming a floor in our residential assets. In N1, I think the ramp-up has been strong. We are kind of almost now touching, what has been done. Okay, that could be a lower number, but going forward, it could touch 58, 60 rupees. Even
and that's including CAM, excluding CAM?
So CAM is always separate. CAM is always separate. That's something we never count.
Okay.
So, so Noida, it could be, N1, it could be around touching 58, 60. Yeah. N2, it would cross 60.
Okay.
Calcutta is around between 40 to 45. That's something very difficult to say 40, 41, 42, but it's around that. And G2, yes, we are close in mid-80s. We are also close in, above 90s on a smaller scale. But with little area left in G2, I think we can cross. We should be inching towards, I would say, 3 digits. I think so, depending on the size of tenant and size of area release.
Understood. So if I look at your rentals in place expiry for the balance of this year, they are pretty much there, right? Except N2, which is still 60 and 52, and N1 is there. Kolkata is pretty much there. Kensington obviously is 111 expiring at 125. So what kind of leasing spread should we run with for the balance of the year?
So we would say that we should be able to maintain the leasing spreads, depending on how much we do in each asset.
Yeah.
But I think last 2 quarters we have been able to get 27%, which was 11% in the last 1 year. So I think this is a critical number, but I think it should be above 20%, I think on an average. But it depends on how much we lease in each asset and what is the size of tenants. But I think we can get about 20% around that number. That's it.
And please, this is Ankur. Across the board with inflation and other factors, commodity pricing, etc. The leasing spread will actually get wider.
Yeah.
Once our leasing crosses 90% on a portfolio basis, the competition on new supply cannot even afford to be at these numbers at a break-even level. Right? So
are you seeing early signs of that as of now?
For sure, traditionally Powai was being leased, in I would say between 110, 115. Now we are talking about 120.
Okay.
So the benchmark itself is moving up. Similarly, Noida, Noida traditionally was a 40 rupee market, then moved to early 50s. Now it's late 50s, early 60s. So look, trends are there, and in fact, I would say, commercial real estate has had not much rental growth to show for, simply because the leasing volumes have been lower. Now in this new regime with slightly higher inflation, I would say the numbers will look different. Is our expectation.
Understood. And N2's occupancy has dropped a bit on a quarter-on-quarter basis. Anything to read there?
No, so I would say, leases can be lumpy at times. We have seen fantastic leasing in N2, last year, the peak of pandemic, and I think discussions are on. So there could be this is a temporary dip. We are confident that
a large part of it actually will happen because we delivered 150,000 square feet of new area in the past.
Okay.
So that's about 5% of the overall sort of area in the park.
Understood. That's very helpful. And lastly, just a bit of accounting thing to side. So there was a 85 million of non-refundable advances uh, why was it classified below cash flow from operation? Should it not be a part of cash flow from operation the way brokerage and deposits are expensed out?
Puneet, it is accounting term-wise below operations. It is considered as technically an equity contribution. That's why it is not shown as a operations income. Because whatever revenues or profits will be generated out of this project in future, once it gets operationalized, that will be given to the partners. So technically, equity.
Sorry, I didn't understand this. Then I think what are these non-refundable advances here? I thought they were more in the nature of deposits.
This is non-refundable deposits which we are getting from the partners in 3-acre development, mixed-use development happening in the Calcutta, K1, where X percentage of revenue will be shared with the partner, and 78% is going to be with us.
Understood. That's very helpful. Thank you so much, and all the best.
Thank you. The next question is from the line of Manish Agarwal from JM Financial. Please go ahead.
Yeah, hi, good afternoon. My first question would be pertaining to the margin profile, NOI margins. So this quarter we have reported 107% on a blended basis, while last quarter it was 105%. So should it stabilize at these levels, or can it go even higher across assets as CAM margins improve, as physical occupancies improve?
Manish, if we talk about the pre-COVID scenario, the percentages were in the range of 111 and 112%. And we expect when the physical occupancy we will stabilize, we will be able to achieve the similar percentage. And that's why we even in our presentations have mentioned that there is still a scope of improvement in the operating margins, and the overall 17 to 18% NOI increase will be there once operations are stabilized, as well as the vacant area is leased up.
Sure, understood. Second question would be on the same store expiries. They have increased by 53,000 square feet. If you could help us understand the nature of this expiry.
So we had see, in terms of expiries, we have about 27,000 has increased last quarter. We had 84,000 renewal, out of 60,000 has been renewed and 27,000 has been expired.
Yeah,
I don't know.
So I'll add to that. Basically, one of our occupiers in the Noida assets has decided to let go of a floor. That's really the reason for the increase. So this particular occupier is essentially, has decided to let go of a floor as their lease expired, and so basically they gave us a termination notice on a floor, and that's why you had that increase in the expiry profile.
And they're shifting to some other property, or they are rationalizing space internally?
They're rationalizing space internally. Who knows, they can come back also. But yeah, right now, 6 to 9 months, a lot of tenants are rationalizing space.
Sure. Thank you. That's all from my side. All the best.
Thank you. The next question is from the line of Kunal T. from BOFA. Please go ahead.
Sure, thanks. My first question is that the opportunities under discussion that you've put forward, it's a good absolute number, but the quantum seems to be unchanged from last quarter if you adjust for the signings you've had. Now, given that the quarter did see a lot of RFPs, just wanted your thoughts as to why that might be.
Sorry, can you repeat the question? I've not understood.
Okay, if you look at your ongoing leasing discussion, the number is 1.1 million. I believe last quarter this was 1.4, 1.5. So adjusted for the signings you've had in the quarter of about 0.3. You're saying that nothing new came into the pipeline as such. Just wondering as to why that might be.
No. Okay. Okay. Sorry. Okay. So see how it happens is, and we can compare tenant-wise tenant and opportunity-wise opportunity. Sometimes, there's out of 1.1 million square feet, we have close 3 lakh square feet. Now, some tenants, probably would not have signed or they could have further delayed, and a lot of new tenants get added up. Now, it's just a question of, it's just a matter of coincidence that this 1.1 million remains 1.1 million. That's how it is.
You're saying there could have been some churn from the pipeline last quarter?
Yeah, churn happens and people come back also. I mean, we only talk about active leases. Sometimes will also get slow, so this is a bit of a dynamic market. We only talk about active leases, and who knows when something gets active. But right now, active discussions are 1.1, and then we have about 0.35 hard options. So I would say overall around 1.5 million square feet. That's how we should look at it.
Okay, sure. On the releasing spreads, I just want to extend the question that you had earlier on G2, that even N1 did show a minor dip in the quarter, I think -2 or -3. Again, is that a case of releasing with an anchor tenant or something else?
No, not really. Yes, N1 did see. N1 what happened, there are certain new tenants, so their areas are small. We thought let them just get in, and of course, they'll take more space, and that's the time we can always get better rentals. So -1%, -2% can happen actually. That something is fine. Overall, we are very confident to be able to surpass the, kind of actual numbers by wide margin in one. That's something we are very confident. And that you should see very soon.
Got that. Okay, thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Thank you very much, and very good afternoon to everyone. I'm on slide number 7 and looking at the NOI growth bridge that you have given. So just questions on this. So what's the rough timelines that you are looking at in achieving this? And second is what kind of occupancy is assumed over here?
So see, what I think we have said that earlier also, we expect by, sometime towards end of next year, we should be able to achieve this. And of course, to achieve this, we need occupancies in high 90s. We will have to definitely cross 95%. And that's definitely, we are confident of achieving those occupancies because these assets have seen, occupancies to the 100% level, whether it was N2 or G2 or even K1. So we are confident that we should be able to, reach or inch towards 100%. But to achieve these numbers, we definitely need, the occupancies have to cross 95%.
And Sameer, if I may add, with the reforms that are happening in the entire SEBI regime, one thing is our assets are designed for 100% occupancy, so there is no structural vacancy in our properties. And with the opening up of the space altogether, I would say that these numbers are both in terms of releasing spreads that we hope to achieve as well as time to get to the high 90s look a lot more favorable. In addition to the fact that back to work regime is firmly in place now.
Yeah, thank you very much. Very helpful. And just on the timelines, Alok, when you say end of next year, I mean, that would be the first quarter exit rate. Is that what's implied? Or by end of next year?
I'm saying towards 23 end. Towards 23 end, actually. Last quarter.
23, that's current year.
No. I'm saying calendar 23 end. So I would say, 18 months from now.
Okay. Got it. Very clear.
Around that.
I mean, this is an exit run rate, like you said. This is a run rate number, 1,100 crores.
Okay, fair enough. Yeah. And the second is, if I'm not wrong, the G1 ROFO validity is till August 22, no? I think that's what the slide mentions. And we are right there. So should we expect the conclusion of the deal this month, or can this be extended?
So this is Ankur, Sameer. So look, as the stats on slide 8 show, that the occupancy of this asset is at 77%. So we have, this needs to move up. or there needs to be a structure. So it's actively, it was actively under discussion. We are not going to have a resolution of occupancy in the short term, but the board did deliberate upon it, and at this time, at least, there is no reason for us to exercise the call option on this asset with these occupancy numbers. But we are evaluating it still, if there's anything else that we can structure around it. So more to come on this space in future. But yes, this asset remains part of the Brookfield sponsor group, and will remain available should the REIT, should the physical occupancy numbers in terms of leasing numbers improve going forward.
Okay. So which means even if it spills beyond August 22, the asset would remain available to us. This
asset would remain the Brookfield sponsor group at this point.
Okay. Okay, that's fine. And the other question I want to check is, in your micro markets, do you see much of GCC demand, and would you make a distinction between what GCCs offer versus large IT companies offer?
So we have a, if you really see, we have a, kind of a mix of demand. But for really GCCs to come, when GCCs are putting their buildings, they typically would say build-to-suit development. Actually, they would plan for, a full building, dedicated building, build-to-suit development. So that's where we stand.
That's Samsung, for example.
Yeah. So yes. So exactly. So Samsung, something, when they saw the building, it's a new building which got constructed. This other building, they said we want to be this building. They're occupying more than 50% building. But yes, this is demand. So right now it's a mix.
Okay, but you remain much more skewed towards IT services for your micro markets. Yeah?
I mean, if you look at the trends, it's actually a mix. We have, for example, in assets like N1, we have Barclays and we have Amazon. We signed leases with Legato, Samsung. We also have a large presence of TCS as well as Accenture. I would say the mix is very healthy right now, because you also don't want to be overweight one particular aspect. IT companies today have been, are sitting on a huge bench of people that they've hired, but have not probably, found an office desk yet. So I would say the growth might come a lot from IT companies as well going into the future. The GCCs are always clunky deals. They always take a large space, and it takes time to develop solutions for them. So I would say, underlying business, whether it's done through an IT company or GCC, largely remains the same. GCCs have come in a big way over the last, few years. They continue to be solid in across our portfolio, the REIT and the non-REIT assets. But IT companies have also moved up the value chain, and many IT companies do very dedicated work for large tenants operating out of our spaces. It's actually tough to really see through always whether it's what type of business is happening.
But let me just, Ankur, if that's okay, let me just give you the breakup of the last quarter. I think that will give you some insight. We have almost 25% of an engineering company. Then we have consulting, again another 25%. We have e-commerce. We have healthcare. Healthcare is big actually, and the IT or the tech companies which you're talking about was only just about 10%. But of course, it's mixed and change. That's why I'm saying, I'm not really getting into a mix. Even last quarter we have logistics, we have engineering. Last quarter we're talking about, last quarter. Again, it was logistics, it was insurance, it was healthcare. So that's where we stand. It's not predominantly tech. Tech is of course large part, but it's not that it's predominantly tech. All right.
Okay.
Yeah.
Okay, great. Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. As there are no further questions, I now hand the conference over to Mr. Ankur Gupta for his closing comments.
Thank you very much, everybody, for your participation, and we look forward to furthering our interactions in the next quarter. Thank you very much. Have a great day and a pleasant week ahead.
Thank you. Ladies and gentlemen, on behalf of Brookfield India Real Estate Trust, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines.